Hello, I'm Andy Agathangelo. I'm the founder of campaign group Transparency Task Force. We are a certified social enterprise. Our purpose is to reform the financial sector so it serves society better. So there's a great deal of alignment between what our organisation is about and this evening's subject, which is the true purpose of banking. Transparency Task Force was established in 2015, initially as a little hobby of mine, but it quickly took over my life, and I now spend all of my time campaigning for reform in the industry, both directly through Transparency Task Force, but also through the all-party parliamentary group that we are the secretariat for. I'll briefly mention that just a little while ago, I was in the Palace of Westminster, our Parliament, observing the proceedings of a meeting of the Backbench Business Committee that was deliberating on whether to run an event, or I should say a debate in Parliament, about misconduct in banking around a theme called hidden credit lines. We won't know for a little while whether that hearing has approved the debate, but fingers crossed that will be the case. And it would be a great debate to happen because it will create a tremendous opportunity to raise awareness of all kinds of banking shenanigans that have been going on in the UK for quite some time. The last thing I'll say about the Transparency Task Force is that we are truly international. We have people receiving our weekly newsletter with Transparency Times in 21 countries around the world. The internationalization of Transparency Task Force took place mostly in 2019, when I personally ran meetings in Dublin, Amsterdam, Zurich, Brussels, Washington, DC, Boston, New York, Sydney, Melbourne, Hong Kong, and Singapore. And as a consequence of all that activity, we truly have an international perspective on these issues. And of course, there's nothing more international than the global financial system, the global money system. And of course, at the very heart of that, we have the banking system itself. I'm going to be sharing my screen just to draw attention to the true focus of our conversation tonight. And I'll be doing that by making reference to the webpage Alexandra, our head of events, created for the session. I'm going to be reading out what we say there. So bear with me while I just get my Zoom screen sharing. Here we go. I'm going to talk a little bit about our event, and then I'm going to be talking about our speaker. I'll read this out. It's very nicely framed. Compliments again to you, Anjan, for the way that you articulate your message. It's really effective. Banks and other financial institutions play a fundamental and yet divisive role in the health of any economy. As lenders, they are important to everyone seeking a mortgage or a car loan. As investors, they are essential gears of economic progress. And yet, when crises hit and the economy tumbles, they are vilified. Is it possible for the banking and financial sectors to both be crisis-free and sustain economic growth that benefits everyone? This is the central question that Anjan Thakur, one of the world's leading analysts of banking and financial institutions, takes up in this insightful overview of the purpose of banking. He starts with the foundation of banks as safekeepers of assets and providers of liquidity, crucial to a dynamic economy. Banks manage risk, monitor borrowers, create trust, are providers of information, and facilitate innovation. And yet, notwithstanding these essential purposes, the reputation of banks has suffered tremendously in the wake of crises that have harmed the financial sector, the real economy, and many people. Just on that note, many people, the global financial crisis, we understand from research by Oxford University, by the way, folks, caused, we understand, around 10,000 suicides as a direct consequence of the economic implications of the financial crisis. The crisis happened, many people lost their jobs, and obviously that led to a downward spiral for, unfortunately, 10,000 people across the UK, mainland Europe, Canada, and the USA. The reason, Thakur argues, is that banks have lost sight of their higher purpose, which is tied to their role as safekeepers of assets and creators of value. These essential economic functions should drive banks' culture, capital structure, and customer relationships. Credit ratings cannot replace relationships, however. Leverage is no substitute for judgment, and the pursuit of profit should not come at the expense of prudence. Thakur shows that while governments can play an important role in creating the environment of banks, including through microprudential and macroprudential regulation, ultimately it is up to banks themselves to improve their culture and align it with their purpose in society. And just to be blunt about it, ladies and gentlemen, the purpose of banking is obviously key to the workings of the financial system, the efficacy of the regulatory framework that governs the sector, and what people, ordinary people like you and I, experience as a consequence of interacting with the industry. Anjan is the John E. Simon Professor of Finance at Washington University and St. Louis Olin Business School, and he was previously served as interim dean from 2022 to 2023. He's an internationally recognized scholar in banking, corporate finance, and financial intermediation. His research focuses on financial stability, regulation, corporate governance, and higher purpose in organizations. His work has appeared in leading journals such as the Journal of Finance, the Journal of Financial Economics, and Review of Financial Studies. And he is the author of influential books, including the one we're discussing tonight, ladies and gentlemen, The Purpose of Banking. Professor Thakur is a recipient of the Financial Intermediation Research Society Lifetime Achievement Award and an honorary doctorate from the University of Gothenburg. Ladies and gentlemen, can we please first of all show our appreciation to our speaker tonight, and then I'll pass straight over to Anjan. Anjan, thank you very much indeed for being with us. We're very appreciative that somebody of your caliber is taking time out to talk to us about your work and your book. Anjan, over to you, sir. I'm aware you've got some slides, so feel free to share away. Thank you very much. Thank you.
Thank you, Andy, for that very generous introduction. It's an honor and a pleasure to be here to talk about this book. It's one of my passions, and so this is really, really a treat for me. So let me start by see if I can share my slides here. All right, so this book was really inspired by the desire to share some of the most exciting research that has taken place in banking and financial markets in the past few decades, and to share it in a manner that was accessible to a broader audience than other finance professors or economics professors. So it was really inspired by that desire. Now, I used the book in an executive MBA course that I teach here on global financial markets. So that was not really the main purpose of writing the book, but it's turned out to be very useful for that as well. So I want to start by sharing with you a story about the first time that I started teaching banking in the MBA program. My first job was at Indiana University in Bloomington, and I was teaching this banking course to a group of MBAs. And 2 or 3 weeks into the course, I had one of the students come to my office and say, "I'm really confused about the things that you're talking about in this course." And so I said, "Well, what is it that you're confused about?" And he said, if banks are where all the money is, then I don't understand why they work so hard to do all of the things that you're describing in this course, like pre-lending, credit analysis, and post-lending monitoring, and designing credit contracts, and figuring out how much collateral to demand. If they have all the money, why don't they just run with the money? Why don't they just take the money and abscond with it? And I must say I was stumped by the question, because nobody in any class that I taught had asked me this question. So I mumbled something about, yeah, we have laws against that. The police come after you and they put you in jail. But that's actually a very deep question. And I have a much better answer now than I did back then when I first started teaching banking. But I think it points out one of the stereotypes that a lot of people have about banks and what they do, and maybe those stereotypes are not quite as blatant as why don't banks just take the money and run. But nonetheless, I think there is a messaging problem when it comes to banking and society, and I think that problem is made worse when we have financial crises. So those are some of the things I'm going to touch upon. In the interest of time, I'm not going to show you this South Park YouTube video, but it's basically about how banks abuse trust and mismanage money. And I think that's a fundamental issue that we, as people interested in banking, need to deal with. So the basic question is, what is it that banks do and why do we care? And of course, we care because banks are huge and they affect all aspects of our lives. Collectively, for example, the top 5 banks in the US have assets that exceed the GDP of every country in the world, except the US and China. And in some cases, as many of you are aware, the largest banks in Europe have assets that are almost equal to the GDP of the country that they're headquartered in, or in some cases even exceed the GDP. In the case of Iceland, for example, I remember during the financial crisis, people talked about how the 5 biggest banks in Iceland had assets that were something like 500% of the GDP of the country. So that has given rise to this notion about making the transition from too big to fail to too big to save. And there's a lot of research that's been done on some of the challenges that poses for countries. So let's get to this basic question. What is the purpose of banks? Now, this question it's a loaded question because it depends on what we mean by purpose. Okay. And you can think about purpose in 2 ways. One is, what is the transcendent higher purpose of banks? The contribution goals that they should have to society. And the other is, what are the basic economic functions that banks serve? Okay. And I'm going to talk about both, but you can't talk about the transcendent higher purpose before you can talk about the economic function. So I need to talk about both of them, and the book covers both. So just for the sake of being on the same page with everybody, what do we mean by organizational higher purpose? This is not typically a topic that financial economists address. It's still a very nascent area of research in finance. I got interested in it about 10 years ago from a conversation I had with an organization, behavior colleague, and a friend, and a co-author from the University of Michigan. And that led me down this path of exploring this whole notion of purpose. So what do we mean by higher purpose? A higher purpose is essentially a contribution goal that explains the why of our existence, whether we're talking about an individual or an organization. I like to explain it as, what would the world miss if we were not around tomorrow? And that applies to an organization, it applies to an individual. So it obviously connects to leadership. Now, at the personal level, there are many different definitions of purpose, but generically, they all come down to something like this. A purpose is something that motivates you to engage in business practices that fulfill a need for purpose in life within you and transcend the usual business goals like money and promotions and so on. Okay. So Leiter defines it as the deepest dimension within us, our central core or essence, where we have a profound sense of who we are, where we came from, and where we're going. Purpose is the quality we choose to shape our lives around. Purpose is a source of energy and direction. So that's at the personal level. There's a similar application at the organization level, which is, what is the contribution that the organization makes to the greater good, to society? Right? And so this is, even in the US, and I don't know about other countries, I haven't studied what organizations do in those countries, but in the US, for example, this is still a fairly new idea, even though many business leaders have talked about it. So, for example, if you look at Fortune 500 companies, about 425 of them have a mission statement, which I view as a level objective, but less than 125 have a written higher purpose statement, something about why do we exist? What is our contribution to the common good? So I'll take a company that my friend and colleague Bob Quinn and I wrote about in our Harvard Business Review article, DTE Energy. So this is a utility, an energy company outside of Detroit. It's the old Detroit Edison. And their mission statement, if you go to their website, is to be the best operated energy company in North America. But that's not their purpose statement. And their purpose statement, it has 4 pillars and it's on the website and it's all fleshed out. But at a very high level, it's to be a force for good and contribute to the prosperity and well-being of the communities that they serve. Another company, an appliance company, American appliance company, Whirlpool, their mission statement is earn trust and create demand for our brands in a digital world. But that's not their purpose statement. They don't have a purpose statement. So they're like many companies that have a mission statement on their website, but don't really have a purpose statement. So this is still a movement that, in my view, is in its very early stages among corporations. Now, some thoughts on what I think of as higher purpose. It is not charity. It is not disconnected from the day-to-day business of the company. So, for example, a shoe company that makes a large donation to a local charity, that's great. It's to be admired, but that doesn't define the company's purpose. That's not something that is integrated with the company's day-to-day business and the economic functions that it serves. A purpose statement is not a mission statement. I often have this confusion among people. A purpose statement, a higher purpose, acts as an arbiter of all the business decisions that the organization makes, and yet it transcends the usual business goals like shareholder value maximization or profit maximization. And so you're making decisions at the intersection of your business goals and your higher purpose goals. All right. So with that, we come to the question of banks. Okay? And what should be the higher purpose of banks? And since higher purpose is not charity, but rather a contribution to the greater good, society at large, that the bank makes within the context of its day-to-day business, we need to first understand the essence of what banks do. Okay, banks do a lot of different things, and it's easy to get confused and distracted. But what is the core essence of what banks do? Why they came into existence in the first place, and what's the most important economic function or the set of economic functions that banks serve? So I want to talk about that, and then I'll come back to talking about how that connects with purpose. And are there any examples in the real world of banks that actually have a higher purpose? All right, so the business of banking, that's what I want to turn to. What do banks really do? One of the most fundamental things that banks do is that they create private money. And they do it literally out of thin air, okay? And this actually lubricates the real economy, the non-financial sector, and it enhances economic outputs. So how do banks do this? And this is covered in chapters 1 and 2 of the Purpose of Banking book. But I'll give you the way that I present it, not the technical paper that we published in 2018 in the Journal of Financial Economics, but this is the story behind it. So I always start when I talk to my executive MBA students and I introduce this topic, I always ask them, which are the second and third oldest professions known to mankind? It's an adult audience. I don't need to talk about the oldest profession. And it's a trick question because I have goldsmiths and bankers in there. But the answer is the second oldest profession is actually lawyers, which is kind of interesting to me because we had lawyers before we had goldsmiths and bankers. Says something about us as human beings, right? And then, it's a trick question because bankers in Europe actually evolved from goldsmiths, but in some sense, bankers, and for example, in Egypt, some people, economic historians claim, actually evolved from ancient commodity warehouses. So they even predate the European goldsmiths. So banks are really at the epicenter of the financial system, and they create liquidity, as Andy mentioned in the introduction, and therefore private money, literally out of thin air. And so let me explain how this happens. So the invention of banking, and so economic historians claim that banking seems to have originated in ancient Mesopotamia, and some of the earliest recorded laws pertaining to banks were part of the Code of Hammurabi. Initial deposits in these ancient commodity warehouses were grain, precious metals like gold and silver, and loans were made, interest was paid in. Okay, let me go back to slideshow. All right, um, so the basic idea is this. Suppose you have a warehouse in which people are depositing some commodity, let's call it gold bricks. And so depositors bring their gold bricks. So let's say Andy brings these gold bricks to my warehouse and he brings 10 gold bricks. So I give him 10 receipts. Okay. And it doesn't have his name on it, but each receipt says this is a receipt for one gold brick. And then let's say Andy goes to purchase some service from Alex and buy some food or something, and Alex says, well, that's one gold brick, and he gives her a gold brick. Now she needs to safeguard the gold brick, so she's going to bring it back to my warehouse, and I'm going to give her a receipt which says, okay, you have one gold brick that you deposited in the warehouse, you can withdraw this anytime you want. What happens is over time people realize that this is very inefficient, right? It's very inefficient for Andy to give a gold brick receipt to Alex and for her to bring it back to the warehouse. And so after a few transactions, people realize that it's more efficient if instead of giving Alex a gold brick, Andy just gave her a receipt. Okay, so that then Alex doesn't have to come to the warehouse, give me a receipt, take a gold brick, give it to Alex, then she brings it back to my warehouse. I give her a receipt. It's much more efficient for Andy to just give Alex the number of receipts that she needs for payment of whatever goods she sold to Andy. So effectively, these warehouse receipts end up being used as a method of payment, even though we don't have any fiat currency or coinage. Now, so far, this warehouse is not a bank, even though it's issuing receipts that are used as a method of payment. But then at some point, somebody comes along to me as a warehouse manager and says, man, you've got a lot of gold bricks in this warehouse. And the inventory isn't moving much because nobody's coming to withdraw and redeposit gold bricks. So I have this idea for opening a new restaurant. I need 50 gold bricks. And since they're just lying here doing nothing, why don't you loan them to me? And my idea is really good. And then I have an epiphany. And I say, something? We can do something even better. Yeah, I trust your idea. I'm willing to make you the loan. But why do I need to give you 50 gold bricks? I can just write 50 receipts, each one representing a claim on one gold brick. And now what I've done is I've created 50 receipts for which there is no gold brick inventory backing the receipts. And you say, okay, that sounds fine. If people will accept these so-called fake receipts as payment for goods and services, then I'm happy to take that in lieu of 50 gold bricks. And the interesting thing is that nobody can tell the difference between these 50 fake receipts that I just created and the so-called authentic receipts that are actually backed by a physical inventory of gold in the warehouse. So what I've essentially done, this epiphany now converts the warehouse from being a warehouse and just a place to safeguard valuables to actually being a bank. And so now these fake receipts basically represent private money that the bank has created. And this enhances economic output. And what we show in our paper and what I discuss in the book is that this allows the economy to invest more in these real projects than its entire initial endowment of physical capital, because the bank has created private money out of thin air. And so to do this, to create this private money, the bank has to really play two roles. It has to take in deposits and safeguard them, and it has to lend. So critical for this lending is the creation of private money, which we call fake receipts. They're not really backed by any deposits, but they cannot be distinguished from the so-called authentic receipts. And they're both claims on the bank. Okay, so they're liabilities of the bank. And at some point, if you present those receipts, then the bank is obliged to pay you in gold bricks. So this is a process by which deposits are creating loans. When we teach banking in most banking textbooks, the basic idea of banking is to take banks very literally. $90 of deposits come in. I add $7 or $8 in subordinated debt. I add $3 or $4 in equity, and then somebody comes and I take $100 in cash out of that and make a loan. That's a very literal way of thinking about banking. Less than 10% of banking today works like that. 90% of banking actually works like this, where banks are creating deposits in the process of lending, the way that I described. And so most modern banking involves loans creating deposits, okay? Whereas the more literal view of banking is that banks take in cash deposits and lend them out, okay? That does happen, but it's a very small part of banking today. Now, over 100 years ago, people realized this, but it somehow got lost in the banking textbooks and banking research in the past few decades. So this is Keynes, who says it is not unnatural to think of deposits of a bank as being created by the public through the deposits of cash representing either savings or amounts which are not for the time being required to meet expenditures. But the bulk of the deposits arise out of the actions of the banks themselves. For by granting loans, allowing money to be drawn on an overdraft, or purchasing securities, a bank creates a credit in its books, which is the equivalent of a deposit. Okay, and this is what people call creating money out of thin air. And so it means that liquidity is created only through the banking system, through the creation of private money, and it allows firms to invest over and above the cash the depositors have put in banks. You don't need to be limited by that cash when it comes to making loans if you're a bank. Okay. And so essentially, this private money creation that banks engage in is providing working capital to firms. Okay. Now, I first got interested in this question back in 2016 when there was a referendum in Switzerland, where in the aftermath of the financial crisis, there was a lot of criticism by people that part of the fragility of the banking system was coming from the fact that banks could create private money. And so they put this to a vote. And the vote was, should banks be allowed to create private money, or should we go to some version of narrow banking where they cannot do that? And the referendum was soundly defeated, meaning people voted by over 60% to actually continue with the banking system in which banks could create private money. But it was a very interesting experiment. I don't think in the US we would ever put something like this to a vote. It's just too technical and complicated an issue. And I have friends. I have a friend in the Netherlands who's at the University of Amsterdam and is a finance professor, and he said we would never do this in the Netherlands either. But this was interesting. They did this, but then I read an article in the Financial Times in connection with this referendum, which talked about, and the question that was posed in the article was, what percentage of deposits that are recorded on the balance sheets of Swiss banks, what percentage of those deposits are actually Swiss francs in currency, fiat money? And what percentage is just this private money that banks create? And the answer was 8%. Only 8% of the deposits that Swiss banks recorded as deposits on their balance sheets were actually currency, fiat currency, Swiss francs. The remaining was private money. So that made me wonder about what this was for the US banking system. So I asked some friends of mine who are economists at the Federal Reserve banks, saying, okay, what is this number for the US banking system? And they said, we don't know. These are central bankers. They said, we don't track that statistic. So I actually wrote a research paper with an economist from the Federal Reserve Bank of Philadelphia because I needed access to confidential Federal Reserve Bank data that I wouldn't have access to unless I was working with somebody from inside the Fed. And we found that over the past 20 years, on average, private money creation by US banks accounted for about 90% of all US bank deposits. Okay. So to put this in perspective, end of 2025, there were about $18.5 trillion in deposits on the balance sheets of US banks. Only about $1.5 trillion of that is actual fiat currency, you know, what the US Treasury prints, okay, and the coins. The rest of it is all private money created by banks in the process of lending, the way that I described it. So this is very much how the banking system works in most countries. So lesson number one, in terms of the economic functions of banks, is that the economic functions of banks include safeguarding valuables by accepting deposits of cash and valuables. That's a very important function that banks serve. And this function is so important that if you remember during the financial crisis, the ECB was paying negative rates on deposits by banks within the EU at the ECB. And I remember talking to some economist friends of mine at the ECB saying, how can you pay negative interest rates? When I first started learning about banking, they said zero has to be a lower bound on interest rates you pay because otherwise people just stuff their money under mattresses and they wouldn't put it in the bank. And the response was, well, there's a fee for safeguarding deposits. And I remember talking to a Federal Reserve Bank president saying, and there was also a Danish bank, if you remember, that made the first negative interest mortgage that anybody knows about. And so I remember talking to this Federal Reserve Bank president saying, 50 basis points seems like a really big number when you talk about the cost of safeguarding cash and valuables. And he said, no, you don't realize how costly it is to safeguard these things. He says, I have a lot of money at my Federal Reserve Bank, but I also have my own police force. So, this is a serious matter. So that is a very important function of banks. The other function is to lend to creditworthy borrowers who are expertly screened prior to lending. And but they're also the place where money is created. Okay, so they not only store money, but they also create money, and a significant portion of it. Now, of course, over the decades, banks evolved, and they engaged in, developed expertise in financial engineering, securitization, shadow banking evolved as a consequence of that. And they developed special risk management tools to deal with all sorts of risk, including liquidity risk. Loans are very illiquid instruments, and so they create all kinds of risk for banks. So the question is, how do you liquefy loans? How do you deal with this liquidity risk? This is something I discuss at length in the book, and so it's the process of securitization. It's securitizing all kinds of loans, mortgages, credit cards. And now, at least in the US, it is hard to imagine an asset that is not securitized. In fact, airlines in the US even securitize unsold airline seats. So, you can securitize almost anything. So securitization, what is it? Well, essentially, it's something that involves combining many loans that have similar characteristics, then creating credit enhanced claims against the cash flows of this portfolio of loans, and then selling these claims to investors in the capital market, where you create different tranches or different classes of claims against portfolios sold directly to investors. So the general name for these claims is asset-backed securities. If it's mortgages, then we call them mortgage-backed securities. And this creates a whole variety of claims that you wouldn't otherwise have in the capital market. So just to put this in perspective, if you had a pool of 30-year fixed rate mortgages, which in the US context would have an average maturity of about 10 years, because people don't typically hold these mortgages for 30 years, they prepay them. And you could take a pool of these mortgages with an average maturity of 10 years and create these multiple tranches. And the most senior tranche would have a maturity of less than a year. and the most senior tranche might have a maturity of almost 30 years. So you can create a whole variety of claims through securitization. This market was really big. It grew to about, in the US, grew to about $2 trillion by 2007. And then after the financial crisis, as you all know, it crashed because securitization played a big role in the financial crisis. But securitization really provided the throughput for the emergence of what we call the shadow banking system. And this was basically a collection of institutions like insurance companies, investment banks, and others that performed a lot of the same functions that banks did in terms of lending, except that they were not financed with deposits. They were financing with repos or repurchase contracts in the capital market. And they were using these asset-backed securities or mortgage-backed securities as collateral for their short-term borrowing because they didn't have access to deposits. So this collateral was used for short-term borrowing. And this market grew enormously in the US and other parts of the world prior to the crisis. And then this was combined with a lot of financial engineering innovations like credit defaults. It spread like wildfire elsewhere. Uh, Now, shadow banking is what people point to the most as being at the epicenter of the financial crisis, the 0709 crisis in the US. And because these shadow banks were using mortgage backed securities as collateral for their short term repo borrowing, when house prices began to decline in the US and mortgage defaults went up, the prices of these mortgage backed securities plunged. And so that shrank the collateral that the shadow banks had available for borrowing, and that caused huge liquidity problems in the shadow banking system. Estimates are that at the between roughly late '07 and early '09, about $2 trillion of short-term borrowing capacity in the shadow banking system in the US was destroyed. And this shadow banking sector was about $20 trillion. So it's bigger than depository banking in the US at the onset of the financial crisis. So, and it grew largely unregulated. So, regulators took their eye off the ball. And it was enormously, Andy talked about the number of suicides during the financial crisis. We have similar figures in the US, but we had declining household consumption, more expensive credit rationing, unemployment hit 10%, which for the US is a phenomenally high number. And it caused a deep recession. The labor participation rate fell. And there's a very interesting study done by the Federal Reserve Bank of Dallas, which estimated that the financial crisis cost the US unsuccessful in resolving the crisis. They realized that this was really an insolvency risk crisis. Banks simply had insufficient equity capital. A lot of the equity capital is wiped out because of the decline in the values of mortgages and decline in the values of mortgage-backed securities. And so many of the later initiatives that occurred in the US were aimed at recapitalizing the US banking system through equity infusions that were really supported by the US Treasury and the Federal Reserve. And eventually, these equity shares that the government had purchased were bought out by the banks and they privately recapitalized. But the initial infusion of capital by the US Treasury into the US banking system, I think, was an enormously important step in bringing the crisis to an end in the US. So lesson number 2 is that if you want to have a healthy financial system, make sure banks are sufficiently well capitalized. And I cannot emphasize this enough. If banks don't have enough capital, they cannot serve the valuable economic functions that they serve, including safeguarding deposits, lending, creating private money to enhance economic growth. Securitization has been much maligned, but I think it's one of the most significant financial innovations of the 20th century. And it's done enormous economic good, but it also leads to abuses. And it creates financial fragility, in part because we don't have adequate capital in banking and also inadequate regulations. So I think that's an important lesson. Now, given that banks serve these economic functions, I come back to the question towards the end of my talk about what should be the higher purpose of banks. Now, there are many possibilities, but they must somehow connect to making a contribution to the growth and prosperity of the communities that banks serve. And so the question is, are there real world banks that actually do this, that articulate anything like such institutions? People would come and tell us, well, higher purpose is fine, but in my industry, it's really hard to do this because we're highly regulated. Some of the things that we may want to do to pursue purpose just wouldn't be permitted by regulators because they would view these things as being too risky and not fundamental to the core mission that we're supposed to serve. So banks, insurance companies, airlines. So we set out to examine if this was really true. And we were actually lucky because we found a bank that actually has higher purpose. And I'd read about this bank, and so I wrote about it in an article. And the CEO of the bank actually read the article and sent me an email saying, "Would you like to learn more about us?" And so she set up a Zoom meeting with her executive committee for a couple of hours. And that led to us visiting the bank. We were invited to their annual customer picnic, and we spent 3 days there and then wrote a case study about the bank. So this is called Bank of Bird in Hand. It's a funny name. Bird in Hand is the name of the town where the bank is headquartered. It's in Lancaster County, Pennsylvania. And the bank was the first de novo bank established after the financial crisis that was FDIC insured. So it opened its doors in 2013. And the motivating higher purpose was that Lancaster County has a very high proportion of, there's a very large Amish community. And the Amish, for those of you who don't know, uh, basically they immigrated to the US, Germany, but they are very religious and they have very strict code of conduct that uh, that doesn't allow them to basically access a lot of technology that we take as a given. And so serving their banking needs is not easy for a bank. And so the banking needs of the Amish community in Lancaster County were largely unserved. And so this bank, which by the way only had two Amish, I think, in the initial group of investors, but was inspired by the purpose of serving the underbanked Amish community in Lancaster County. And it's a fascinating bank because they do so many things that are non-standard. And we went to this picnic. We interviewed directors on the board, we interviewed senior management, we interviewed line employees. Picnic, 3,000 people. We were standing in line to be served food, and we would have people walking up to us once they knew who we were, saying, "I have a story to share with you. Would you have a few minutes to listen to me?" And just unsolicited, they would tell us about their experience with the bank and how different it was from any other bank that I ever dealt with. So while recent global banking trends and market developments go in one direction, this bank is going in the opposite direction. So as you well know from trends in the US and Europe, we have a dramatic reduction in brick and mortar branches. We have an emergence of depositories called neobanks that have no physical branches. Checkless banking, for example, in the Netherlands and other countries. Growth of digital banking as a replacement for in-person banking. This is sweeping all across Sweden. And a blurring, but also they have these money trucks that are mobile branches that go from town to town. Um, and and they are not concerned about non-banks taking market share away from them. They are not emphasizing transaction banking. They're totally focused on relationship lending, uh, and they're not increasing tag in the U.S. after the financial crisis and this unlimited deposit insurance coverage in Denmark after the global financial crisis. They're not a bank that is in any sense financially stressed. And one of the most amazing things about this bank is the CEO has sent me emails that they routinely receive from bank regulators. The regulators love them. So this is a story that's almost too good to be true. And I fundamentally believe that it's because they have a higher purpose that guides their decision making and the way they function on a day-to-day basis. So this is just bank regulators' reaction to this bank. Thanks so much for sharing the video. So this is a video that we made about the bank where we interviewed different people, and the video basically shows the interviews. And for the kind words, the bank's journey, including its deep commitment to the community it serves, should be an inspiration to other institutions. It's been so neat to watch your bank grow and adapt to the needs of the folks it serves, yet remains so grounded in the fundamentals from which it's drawn success. I too appreciate. Okay, and so lesson number 3 is that banks must have an explicitly articulated, authentic higher purpose. And I think that this will go a long way in minimizing financial crises. And it makes banks even more valuable to society if banks have an explicitly articulated higher purpose. And I think this may lead them to make strategic choices that differentiate them from other banks and can serve as a source of competitive advantage. So it avoids herding behavior in strategy. And I think Bank of Bird in Hand is a great example of how its strategy is completely different from trends in banking, at least in the US. Okay. And so with that, I'll close. Banks play an essential role in modern economies. They safeguard deposits, they screen borrowers and make loans, they create private money, which enhances economic output. And I think that's a very important point to appreciate. They engage in securitization that expands investment options for investors. They lower borrowing costs for firms and households. They provide collateral to satisfy the short-term funding needs of the shadow banking system through repos. But to minimize financial crises and become even more valuable to society, banks need to have an explicitly articulated higher purpose and be well capitalized. So with that, let me close the talk. Thank you for your attention.
Thank you, Anjan. Thank you very, very much indeed. That was without doubt the clearest explanation of the banking system and how money is created that I've ever heard. And I've heard a few, Anjan. Thank you very much indeed for that. Thank you.
Thank you.
We have a couple of folks here who are lined up to kind of reflect on what you've said. Mike Grimsdale, who's a former banker himself, and then we'll go to Michael Toppin, who's been having some issues with a particular organization. But folks, let's do what we can to focus on the general themes and topics that Anjan has been covering, rather than taking the conversation to different directions. And we'll be wrapping up in about 10 minutes. So again, as always, if I can ask our contributors to be succinct, that would be wonderful. Let's go to Mr. Mike Grimsdale first of all. Mike, would you like to share your reflections on what has been discussed so far tonight and your lived experience of the banking sector? Thank you. Thank you.
Thank you very much for the talk. I cannot say that other than exactly what I went into banking in 1968 with Lloyds Bank. I then moved to Trustee Savings Bank. I was fully trained, fully proficient, and we were a part of the community. I then eventually went on to credit union, and in the UK, the government has very cleverly restricted credit unions from doing the job in community, because instead of the fractional reserve banking of roughly 8 times deposits, credit unions in the UK are only allowed to lend 80% of every £1. So they've actually limited the potential. I'm now trying to help clients get money for SMEs, etc. And the opportunity of dealing with bank managers or anybody who knows about banking is nigh on impossible. They actually have no interest in wanting to talk to people. I could give you many experiences, which I'm sure all of us have had with banks. Unless you're lucky enough to find a person to speak to, the system does not want to know about you as an individual. And quite frankly, my senior bank managers, when I was in Lloyds Bank, will be squirming in their graves because banks should never have in the UK got into building society and mortgages. They were very separate. They did completely different jobs. And the reason why the SMEs in the UK are very lightly supported on smaller SMEs is because there's nowhere for people to go. So I 100% agree with every single word that Anjan said. Thank you.
Thank you, Mike.
Mike, thank you for those reflections. And Jan, we're aware that on the continent, some of the continental banks have what I would describe as an old school type of banking, where the bank
Mhm.
manager actually has a relationship with the individuals and the businesses in the area. Because they know them so well, they can make very well informed lending decisions. They've got very good default rates because they know the businesses, and there's an inherent sense of trust there.
Mhm.
What is it, do you think, that's actually taken what most people would see as the modern view of banking, and I would characterize it with the words
Mhm.
aloof, cold, distant, untrustworthy, lacking integrity, casino banking, all the classic, post-global financial crisis descriptions come to mind. What is it fundamentally that's taken the culture in a non-community orientated direction? I'm very deliberately using that word community Mike just mentioned because I think that word community is a very important word here because it speaks to the
Mhm.
purpose of the institution being about what happens in your place, in your world. And Jen, what would you say to that? What's the fundamental thing that's taken it in that direction?
I think that I think in the US at least, this started probably in the 1990s.
Right.
There was a lot of focus on reducing cost, and we had some regulatory changes that led to consolidation. So at one time, we had 20,000 banks in the US. Now we have maybe 4,000 or maybe a little less than that consolidation. A lot of the consolidation was really aimed at improving cost efficiencies. And so as a part of that cost efficiency movement, people were publishing papers on, how much money you could save by just having remote banking and ATMs and not having tellers and not having people come into branches. And we were making it more and more attractive for people to never step inside a branch and just be remote. And I understood the reasons, the economics behind it, but I also thought that it was a little bit short-sighted because you cannot cross-sell. When we got rid of Glass-Steagall and went to universal banking, and people were talking about cross-selling non-banking products in bank branches. Well, how do you cross-sell if a person doesn't come into the branch? It's a lot more difficult to cross-sell to me if I'm doing online banking on my computer than if I'm face-to-face with you in a branch. And I think a lot of banks lost touch with that. And so I think what I'm seeing now, and I think that the
I think we may have a frozen Anjan. Um, I think Anjan's frozen. Anjan, we can't hear you right now, and you've frozen on the screen.
oh, oh,
That's
I think
that's
I
better.
lost internet connection for a second.
You're
No,
back now. Thank you.
I was saying that I think a lot of this is part of the economy push to reduce costs in banking. But I think
Yep,
this
yep.
movement towards impersonal banking is maybe even stronger in Europe than it is in the US. In the US, we still have community banks, and we have banks like Bank of Bird in the Hand, and we have things like the Farm Credit System. These are all financial institutions and some credit unions that still engage in relationship banking. But I think that it would be a loss to society if we lost relationship banking and this community oriented view of what the purpose of a bank is.
Thank you very much. We're going to go to John Ashton, who's a fellow academic. John, why don't you briefly introduce yourself and then share your thought? Thank you, John.
I'm John Ashton, University of York, Professor of Financial Regulation. Arjan, thank you for the excellent talk. And also, it's lovely to ask you a question as I've cited you many times over my career and work.
Thank you.
Um, I was just wondering, your thoughts on the Community Reinvestment Act. One of the big differences, I suppose, between the US and the UK banking system is you do have different laws. And so
Mhm.
the Community Reinvestment Act tries to build this community link between banks
Mhm.
and their communities and enforce that. But has
Yeah.
this actually been useful or otherwise, in your opinion?
So this is a very interesting question. There's a lot of research done on the CRA. And for those of you who may not be familiar with the CRA, it's basically an act that requires deposits, because the idea is that if you're collecting deposits in a certain community and then you don't lend in those communities, then you don't serve those communities. And regulators keep track of your CRA scores. And if you want to open a new branch or merge with another bank, these scores are actually taken into account by regulators in deciding whether to give you permission to do that. The CRA has had a mixed record, John. There are some people who believe that it's been absolutely fundamental in getting banks to reinvest, especially in some of the low-income communities in which banks are sometimes averse to make loans, that, in terms of redirecting credit to those communities, it's been incredibly useful. There are others who think that the CRA is a
I think we've lost Anjan again there. There's
Oh.
obviously an internet connection there.
Stability in the internet. Okay.
Yeah.
Am I back? Can you hear me?
You are back. We can hear you. Yes. Yes. Thank you, Anjan.
Okay. So I think the CRA has kind of had a mixed record. There are people who believe that it has been very useful in getting banks to direct credit to the communities, especially low-income communities in which they raise deposits. There are others who have claimed in research papers that it has led to riskier lending, that because banks are compelled to lend and make loans that they otherwise wouldn't make, it's led to more risk and more fragility in banking. So it ends up being, at some point, I don't think research has settled the issue, and so it ends up being a somewhat politically charged issue. But I would say the best way to describe it is that it's had a mixed record.
Thank you, Anjan. Thank you, John. Thank you very much. Great to hear that John's got somebody he's talking to tonight that he's cited on many occasions. It's really great to hear. We're going to go to Michael Toppin. I'll briefly describe Michael's background. Michael was a significant fact-based filmmaker in the 70s and 80s and has had a rather unsavory experience, let's put it that way, with a bank. Michael, staying on topic as opposed to talking about your case per se, what would you like to say tonight, Michael? Thank you.
Oh, I think you need to unmute yourself. I think Michael is muted.
Yeah. Michael, please unmute. Thank you. You'll do my job for me, Anjan. Thanks. Michael Toppin, you're still muted. I think it's because he's on his phone. It's a bit awkward sometimes to unmute on an iPhone. I'll tell you what, while we're waiting for Michael, let's go to Mr. Seamus May. Seamus is one of many of our community members in Ireland who unfortunately have had, I would only say, a grotesque experience with all kinds of issues. Seamus, please be as succinct as possible because we're running a little bit over. What would you like to say tonight, Seamus?
Yes, thank you very much, Andy. That was brilliant to hear all this from an American angle from Anjan, and then to hear Mike Grimsdale come in and almost steal a little bit of my thunder. I think, Anjan, you're very much on the same hymn sheet as Richard Werner, Professor Richard Werner. And, we in Ireland, the Public Banking Forum of Ireland, we have worked very closely with Richard and indeed with other people like Ellen Brown in the States on the community banking side of it. And, we're looking at all this consolidation. And yes, you can say consolidation is good because it cuts costs and it increases profits. But when you're dealing with public companies, PLCs, I mean, they just will do anything to increase their profits year on year, whereas a private company can work away with the same profit every year, but that's no good in a public company.
Yeah.
And say in Ireland here, we have had rogue banks for decades, and it ended up in a spectacular crash, as it did all over the world. And Ireland, instead of introducing competition into the market, Ireland got rid of competition. Okay, some banks went bust, but some of the established banks just left Ireland, and they said because they weren't making money. And of course, that's not true. This is all to do with consolidation. So now in our country, in Ireland, we have two major banks and a kind of a mudguard bank, a third bank, and we have massively high interest rates. We in the Public Banking Forum, we offered several solutions, including the setting up of community bank, very much on the lines of the Sparkassen in Germany, which is probably the world's most successful bank when you look at all things over the last 200 plus years. And Mike said something there, which is very, very true. It's about the credit unions. And I've always been making this point. The credit unions can only lend out, if a credit union has 100 million on deposit, it can lend out 80 million. So it has to make its money, it has to make its profit on the interest rate it charges on that money. Whereas banks are creating, it used to be 6 and 8 times what they had in cash, but now when the crash came, it was unlimited. It was just printing money. So there's unfair advantage on the banks, and it's anti-competitive. It has to be a breach of European competition law. So I'd love to hear more from yourselves, and I'd love to hear Richard Werner sharing a conversation as well, because that's very, very much the right track. And I would say there's 48,000 what do you call them? 48,000 lobbyists in Brussels. And this is why all these consolidations and all these ridiculous laws are coming in. So the people who need proper banking were not being heard. And I'll leave it on this. Professor Steve Keen, another buddy, I'd say, of yours, and he stated, ultimately, the financial sector should be the servant of the rest of the economy, not the master. But at the moment, it's the master of not just the economy, but of the politicians as well. So to break the nexus, we need a complete political shift. That's basically where I would stand.
Fantastic stuff, Seamus. Thank you very much indeed for sharing those insights. We're going to go to Michael Toppin. Michael, you have unmuted, but we can't see you, but that's okay. Please do share your points succinctly, then I'll start bringing tonight's conversation to a close. Thank you, Michael, and thank you again, Seamus.
Thanks, Andy. Thank you very much, Anjan, for a very illuminating presentation. It's the most holistic overview I've ever heard about the banking industry. And one thing I'd like to ask you is about the psychology of banking. Why, in your opinion, would you say that the most successful or largely most successful Hollywood genre of filmmaking is, quote, the heist movie? Mostly in the heist movie, they make a lot of money, and usually they're supported by banking investment, out of the fact of the moral ambiguity. When people go and see a heist movie, they really want the robbers to win, don't they? You see Heat, you see the great train robbers, you see Bonnie and Clyde. You don't want to see these people rubbed out by the police. You want them to take the money and get away with it. Now, why would that be?
I don't know. I mean, I think part of it is the genius in the way that they make these movies, right? That they get you on the side of the bandits and on the side of the cops. But I think that, there is this perception that banks are all powerful. They have a lot of money. They exert undue influence in society. And so if somebody goes and steals a few bucks from banks, so be it. But I think that, when I see, and going back again, something that Seamus said, that when you have these privately owned banks like Bank of Bird in Hand, that just...
I think we might be losing Anjan's connection again. Anjan, can you hear us? I'm going to... I'll tell you what, folks, what I'm going to do, I think we may be losing the connection there. I've put a link to Michael Toppin's background and Seamus May's TED Talk in the chat. I'm just going to share my screen to bring a couple of points to the surface, as I think we are unfortunately losing our connection with Anjan. I'd like to talk about an organisation I know a little bit. I know the founder of this organisation, the Global Alliance for Banking on Values. It's basically an international network of banks with a progressive worldview, a society-centric worldview. No time to talk about it now, but if you're interested in banks behaving well, then as opposed to banks behaving badly, which is what we normally talk about, I do highly recommend you take a look at this, the Global Alliance for Banking on Values. So there's a link to that in the chat. I personally see a real glimmer of hope in a piece of legislation working its way through Parliament at the moment. It's not getting a lot of airtime, but I think it's actually quite significant. This is the Company Directors' Duties Bill. In my very, very plain explanation of it, I would say it's about the idea of resetting the priorities of business away from being profit maximizing. I'll read out what it says. It says, a bill to amend Section 172 of the Companies Act 2006 to require company directors to balance their duties to promote the success of the company with duties in respect of the environment and the company's employees. To my mind, this is hopefully the thin end of a good wedge, the thin end of a wedge towards the idea that organizations do start aspiring to a much greater purpose than merely trying to profit maximize in the short term, which of course is what most organizations seem to be doing most of the time. And the third thing I'm going to share with you is a bit of news. Some of you will be aware that for quite some time, there's been an effort underway to try to get an agreement in the UK Parliament for a debate about banking misconduct and that kind of thing. I'm very pleased to say that about 20 minutes ago, I received an email that's been forwarded to me confirming that the debate we have hoped for, that some of us went to Parliament for today, has actually been granted. So let's give everybody a round of applause, because there's been a massive community effort on that. In particular, huge thanks to John McDonnell MP for what he said in Parliament today at the Backbench Business Committee hearing. For those of you that weren't aware of it, I'm going to quickly try to find a link to it and put it in the chat, because it was excellent. While I'm doing this, allow me to briefly see whether there is an opportunity to hear from Anjan once again before we wrap up the session tonight. It would be lovely to hear Anjan's final comments if he has any he'd like to share. Of course, there's a subject to there being a connection to him. So Anjan, over to you if you're still with us and if you're able to speak, sir. Anjan. It looks like the connection is completely broken, unfortunately so. Bear with me, folks. I'm going to quickly find the note I have written to some folks that shares the link to the debate in the conversation in the Backbench Business Committee debate today. It's going in the chat now. If that's of interest to you, click on the link before I wrap up the session. I do it straight away because we're about to close, and you'll be able to watch the first 15 minutes of that, and you'll be able to hear John
I'm
McDonnell,
sorry,
MP.
Andy.
Yeah, Anjan, you're back. Fantastic. I'll just finish off. I'll just finish off my sentence, and I'll pass back to you for the final comments. Okay. So if you do click on the link I've just put in the chat, you'll be able to hear John McDonnell MP articulating the merit of having a debate in Parliament about banking activities. I won't elaborate any further. It's just terrific news that the Backbench Business Committee has decided to approve the idea of that debate. Fantastic stuff. Mr. Anjan Thakur, we've all really benefited from the knowledge you've imparted tonight. We're very grateful to you for that. Apologies for the poor connection to where you are in the States. Anjan, you have the final word, sir. Thank you.
Well, thank you very much. I really appreciate everybody being here and listening to my talk about the book. I really enjoyed writing it. I enjoy using it, and I think your questions and the experiences that you shared were very interesting for me, and I learned a lot from it. So thank you all.
Thank you, Anjan. If you'd like an introduction to the founder of the Global Alliance on Banking Values, I'd be very happy to do that. Just pop me an email and we'll pick up on that, okay? Anjan, thank you very much indeed.
Okay. Thanks, everybody.
On that note, we'll wrap things up for tonight. See you next time, folks. Thank you very much. Cheers, Anjan. Great stuff. Thank you.
You.
Bye-bye. Bye-bye.
Thank you.